welcome to the Monday Futures Market Outlook for August 13th, 2012. This is Patrick Sresna. For those of you that have not had the opportunity to try out the eminisource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a chart of the U.S. dollar index futures, and we can, over the last month, have seen some weakness in the U.S. dollar, trying to consolidate back down to a support line, primarily driven by a small bounce in the euro, as well as a distinct strength in the Aussie and Canadian dollars. Overall, we don't see anything that changes the primary trend of the U.S. dollar, but it does certainly take the wind out of the sails. Really, at this stage, we'll be looking to see where the U.S. dollar puts in substantial supports and from where the basing formations occur. That may take a better part of August. Next year, when we take a look at the Euro FX futures, we can see that the Euro over the last month has been trying to rally higher off after hitting a short-term low in July. Really, at this stage, we are skeptical of the sustainability of this Euro rally, but it certainly doesn't mean that it's inevitable that it's going to break down here. One level that we're watching for that breakdown is the 122, 123 level, where the lows came in just the other trading session. Really, at this stage, so long as those support lines hold, a rally up to 125 or 126 is certainly not out of line here. In the bigger picture, we remain distinctly bearish the euro, but certainly for the next week or two, we could still see the euro establishing the top end of its ranges here as the markets stay relatively calm. Next year, I want to take a look at the 30-year Treasury bond, and the 30-year Treasury hit a very important support line in that 147, 148 level and bounced. This is actually going to be very crucial information that we gain here. This is really the bottom end of the range where consolidations should naturally go if this is just going to be a sideways consolidation. As we bounce here, we're going to be watching the 150 level on the upside. Any rallies that fail to gain any momentum above 150 still leave the window open for there to be yet another round of selling to retest that 147 level, or maybe even drop as low as the 145, 146 level to test where all the highs were coming in January and February. Nonetheless, we are still optimistic that bonds will still yet again have another rally, but just like with so many of the other markets, these consolidations have really begun, and there's no imminent thing that's suggesting that they are that these corrections are finished, and we may see a lot more of the same for the upcoming week to 2 weeks. Next year, I want to take a look at copper futures, and copper has actually been distinctly weak than a lot of the other commodities. In fact, the weakness in copper is a telling sign of what the market is telling us about the strength of the global economies. Overall, the fact that copper is weakening back down to the bottom end of its ranges is again just showing that that our original forecast for copper to still yet weaken to $3 or even $2.90 this year is still a reasonable proposition. While in order for a downside forecast like that to materialize, we would need to see that 325 to 330 support line broken, and that is certainly something that lies only 5 to 10 cents away. And so before we get genuinely bearish copper, let's see how it behaves as it approaches support lines and whether or not the currency movements have any material impact in that. Next year, I want to take a look at crude oil, and the crude oil landscape is one of technicals versus geopolitical tensions. From a technical perspective, we still feel that there's substantial overhead resistance up here on crude oil, where it would naturally roll over and begin at least a correction to retest a lot of the lows it put in over the summer. But with that said, there's always the potential of a geopolitical event in the Middle East occurring that could create a short-term supply and demand imbalance that no different than what we saw in wheat when the drought started. And so anyone that's looking to trade the crude oil technically may want to deploy some form of a hedge in there when trying to short crude. Next year, I want to take a look at gold futures, and gold has now trading into some substantial overhead resistance levels around the 16 and a quarter to 1650 area. This is a make it or break it level for gold. If it is able to exceed these highs, it may gain its own momentum for a 50 to even $100 an ounce push higher. In the same regard, if it fails to show here that it cannot beat this level, the sellers will just as easily trade it to the bottom end of the range. This is a very interesting make it or break it moment for gold, and we'll see whether or not it follows through. At this stage, I would say stay relatively neutral and remain relatively biased to the downside till gold proves that it has broken out. And if gold has broken out, then we can change very quickly to a short-term bullish stance to allow it and see how high it could go. As always, we start off with a weekly chart of the S&P 500, and as always, we plot an 80-week moving average on there to depict the bull and bear market cycles the market has gone through. This year, we tested that 80-week moving average and have found support there and reversed. At this stage, the market from a longer-term stance remains in its bull trend, and there's no imminent breakdown move that is evident here. Next year, when we take a look at the S&P 500 on the daily charts using the E-mini futures, we can see that the S&P is trading right into a substantial overhead resistance where all of its major highs came in this year. We've done this in what is now a 2 to 3 month rally that has not had very much momentum and a lot of low volume. This is not necessarily a healthy environment for the market to be testing this overhead resistance in this manner, but it is what it is. Ultimately, there can be a short-term spurt that can still even see 1420 on the upside, or even a short-term rally that even temporarily tests 1440 on the upside. But we are pretty adamant here that the risk-reward proposition of remaining in the market is marginal at best, if not risky, because the upside potential versus the downside risk of the market, let's say trading back down bottom end of its range of support, is not favorable, or at least it's not worth the payoff. And so really at this stage, we while the trend is higher, we do believe that the risk reward proposition of being in the market is poor. When we take a look at our key intermarket observations, all year we've been relatively bullish the U.S. dollar, bearish commodities, bullish bonds, and bearish global stocks. That long-term trend has been playing out all year long, but right now with the markets having stalled, everything on the short term is pretty neutral. A lot of these things are consolidating and retracing on very low volumes during the summer. We're going to be looking to see where the primary trends can shape up in the upcoming weeks. That was your Monday Futures Market Outlook. Thank you for joining me.